Hello and thank you for joining me for the second week of reporting season this August 2024. I'm Grady Wulff, Market Analyst with Bell Direct. So far this reporting season, we've seen 30 companies report, with 11 beating expectations, 7 meeting expectations and 12 missing expectations. It's only week 2 and we've seen some retailers quash fears of declining retail appetite from Australian consumers in FY24, which has been a huge surprise to the upside, and investors have responded accordingly. JB Hi-Fi, ASX, JBH show great resilience in FY24 despite consensus pre-warnings of retail spend depleting. For the last financial year, JB Hi-Fi reported total sales of $9.6 billion, which were down just 0.4% on FY23. EBIT of $647.2 million, which beat expectations. NPAT fell slightly to $438.8 million, and the tech giant declared a special dividend of 80 cents per share fully franked, which together with the final dividend will contribute $200 million to shareholders. Investors shrugged off the slight declines across some metrics to welcome the very strong start to FY25 for the leading Aussie tech retailer. While JB never provides guidance, the company did outline that July trading has been solid, with like-for-like sales growth of 5.2% in Australia, which again beat the June half growth of 1.3%, while New Zealand sales rose 12.2% in July. JB Hi-Fi's Australian operations in FY24 saw total sales increase 1% to $6 billion, while gross margins eased 42 basis points to 22.2, driven by sales mix and increased levels of on-floor discounting to move inventory. Cost of doing business was up 12.6% and in absolute terms grew 5.5%, with disciplined cost control helping to manage inflationary pressures. JB Hi-Fi has announced an agreement to acquire 75% of E&S Trading Co. for $47.8 million in cash. E&S is known for offering top kitchen, laundry and bathroom brands. For FY25, JB Hi-Fi aims to sustain growth without heavy promotional activity, as retail spending has begun to slow down, a trend noted in FY24. The slight decline in JB Hi-Fi's sales to $9.6 billion was driven purely by JB Hi-Fi's The Good Guys business, which experienced a 4.8% decrease in sales, which is interesting as online home retailer Temple & Webster exceeded expectations and its share price soared on release of FY24 results. Talking about Temple & Webster, for FY24, ASX TPW Temple & Webster felt no slowdown in consumer spend on homewares, with the online decor company defying the odds to reach record annual sales. Over the financial year, TPW reported record revenue of $498 million, up 26% year on year. Active customers rose 31% to an all-time high of 1.1 million. EBITDA, excluding one-off costs, came in at $13.1 million with a 2.6% margin, and FY25 has started very strong, with trading up 26% from July 1 to August 11, 2024. Temple & Webster is a very capital light business, which reduces costs on an operational and inventory front due to its innovative drop shipping model nature, i.e. the products consumers purchase go directly from the warehouse to the customer. The online furniture retailer also boasts no debt, free cash flow and a closing cash balance of $116 million at the end of FY24. A year ago, analysts were concerned about the $1 billion midterm annual sales target of TPW, but this figure really doesn't seem unachievable for the company after analysing the results out of the company yesterday. Elsewhere, biotech juggernaut ASX CSL came under pressure on Tuesday despite posting a strong result across the board for FY24. For the last financial year, CSL reported an 11% increase in revenue to $14.8 billion, which beat expectations, which was US dollars, sorry. Net profit after tax before amortization rose 11% to $2.91 billion US dollars. A final dividend of $1.45 per share was announced, and the company guided toward FY25 NPATA forecast to be in the range of $3.2 billion to $3.3 billion, implying growth of 10 to 13%. While this all looks very positive, investors were seemingly unimpressed as shares in the company fell 4%. But why? Well, CSL is currently trading on a PE of around 40 times, implying high growth outlook, and with the outlook for earnings growth between 10% to 13% in FY25 announced yesterday, investors were expecting to see higher earnings guidance to justify the currently high valuation of the stock. Declining flu and other vaccines sales outlook and easing pharmaceuticals growth is anticipated to ease earnings in the near term. And shares in online jobs advertising platform Seek ASX SEK fell 6.6% yesterday as its FY24 results released reflected a tough global employment headwinds faced in the last financial year. In FY24, Seek reported revenue from continuing operations fell 6% to $1.084 billion due to lower volumes. OPEX rose 1% while CAPEX fell 8%. Adjusted NPAT came in at $177.4 million while the company reported an NPAT loss of $60 million compared to a profit of $240 million in FY23. Seek has also slashed its full-year total dividends from 47 cents per share to 35 cents per share in FY24. Seek's results were also impacted by a $141 million impairment charge related to Seek's investment in Zhaopin due to weaker jobs environment in China and revenue decline for the company, which is a leading career development platform in China. On the guidance front for FY25, the company expects total revenue between $1.02 billion and $1.14 billion, adjusted NPAT of $130 million to $180 million, EBITDA between $430 million and $500 million, and total expenditure between $740 million and $810 million. These metrics imply eased earnings are expected against higher costs in FY25, which naturally spooked investors yesterday. Let's look at what the key takeaways are of week 2 so far for this reporting season. Outlook is everything. The outlook for FY25 across the board, besides for some retailers, is a very subdued demand environment and paints a broader picture of the state of the economy in this high inflation, high interest rate environment. Companies with operations or exposure to China felt financial strain in FY24. Retailers have surprised to the upside and investors have responded with mass buy-ins for the likes of Temple and Webster, given the resilience in FY24 that is carrying into FY25. Inflationary pressures are eating away at margin expansion, which investors have been very quick to punish on a share price front this reporting season. And that's it for our reporting season week 2 update. Stay tuned for the reporting season wrap for week 2 on Friday.